Five of the nation's top regulatory agencies voted to approve the so-called Volcker rule today. It bars big banks from making high-risk investments with company money, putting the firm and taxpayers at risk if the bet fails. With some clarity now on those new rules, shares of some of the nation's biggest investment banks ended slightly higher today, as you see there. Eamon Javers in Washington with more. Eamon?
Hi, Tyler. Well, today, Washington moved to ban what regulators see as one of the potentially riskiest parts of the financial system. Banks trading in their own accounts. It's known as proprietary trading. In a snow-shuttered Washington, it was an understated launch today for the long-awaited Volcker rule in public meetings at the Federal Reserve.
All in favor, say aye.
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 And at the FDIC.
All in favor, please say aye.
Aye.
Thank you very much.
Other regulators across the city joined in, banning proprietary trading by banks, but the new rules include 5 major exemptions. Banks will be allowed to conduct underwriting as long as their positions don't exceed certain limits. They will be allowed to engage in market making, but inventory may not breach certain levels. They'll be allowed to hedge their positions, but they have to document what the hedge is for. They will be allowed to trade in government debt like treasuries and munis. And some foreign entities will be allowed to trade so long as those risks stay overseas. All in all, regulators said they're pleased with how the long-fought-over rules turned out.
It stops the wild flyer bets that are just for the house. It will allow legitimate hedging activity for legitimate business risk.
But, Susie, the rules build in a lot of subjective judgments that regulators are going to have to make. And that means a lot here is going to depend on how the regulators decide to enforce what they've written. Back to you guys.
All right, thanks a lot. Eamon Javers reporting from Washington.